Now, Jeff Powell is managing partner and CIO at Polaris Greystone Financial Group and joins us live from San Francisco to give us his perspective on the markets. Jeff, it's great to have you on the show. Thank you very much for your time. As Nancy and I were discussing, it really boils down to the signaling part of the equation on December 15th. If there is no surprise in the works, if tariffs indeed don't kick in, President Trump will have to manage expectations around the trade negotiations and whether or not a phase one is actually in the works. Your sense?
Yeah, I mean, absolutely correct. I mean, right now, you kind of hit the nail on the head with what's going on this week. We obviously have the Fed Reserve and their numbers coming out on the 11th. If you're looking at Fed futures, it doesn't really look like we're going to see any kind of change there. I couldn't agree more with you that the Fed is kind of doing a wait and see to what's happening. It kind of feels like, you know, Donald Trump is kind of playing with the markets every once in a while. Whenever it kind of feels like this deal isn't going through, then we get a tweet or we get a comment from his party that basically is talking about how a deal is really close to getting done. To your exact point, though, I mean, this last tariff is truly, you know, what would have an impact on the average consumer. I don't think the average consumer is thinking about their Christmas purchasing on when a potential tariff is going to go in. So maybe there is a lot of the purchasing that's already happened, but there's still 2 more weeks before the holiday is over for people to be buying, and that certainly would have an impact on retailers.
But how would that get reflected in the markets, which have done so well into the year, or actually to close out 2019, 25% up on the S&P 500, and in just the last 2 months, the momentum has really kicked back in. How do you think that story unfolds going into the new year?
Well, keep in mind this, the returns in the market so far this year, part of it was a recovery from a really bad time this time last year. If we were having this conversation in December last year, we would be having a very different conversation than the momentum that we've seen so far. So while we are up 25% for the year, some of it was recovery from what was going on in fourth quarter of last year. But the markets don't like uncertainty. So if you're in a situation where these tariffs start kicking in and you've got 70% of our economy driven by personal consumption, and this will be the first of the tariffs that are really kicking in that have a true impact on the consumer, you've got to imagine that it definitely has an impact on how consumers spend.
And Jeff, I think there is a fear out there in the market that if this doesn't get resolved by year end, by this December deadline, then it just adds to the uncertainty as we get closer to the election. And very interesting story on our website right now that I want to bring to our viewers' attention, talking about the fact that investors have been hedging ahead of this election. And if you look at downside puts timed for a year from now, so just after that U.S. election, in fact, at historical levels compared to upside calls. And a strategist at BTIG has said that investors could be worried about an election apocalypse. I mean, what do you make of this as you assess the election risks?
Yeah, I actually saw that as well prior to you guys writing your article about it. It's actually a very interesting thing because it's actually looking a month out after the election. You would think that, again, someone might want to hedge the uncertainty of the election. Personally, I think the trade deal probably goes through well in advance of the election. It would be a great feather for Donald Trump's hat to sit there and say, I've got this deal done with Mexico and Canada. I pretty much have a trade deal done with Japan, and who knows if that happens before the election. Having a China deal in pocket to be able to sit there and say, hey, look, I told you I was going to cut taxes. I did that. I told you I was going to do all these other things, and I've done those things. Going into an election would give him a lot more strength than to play the game right now that he's playing. An election apocalypse, I think that part of it is hedging. If we have an Elizabeth Warren who might actually change how small businesses are run and how the wealthy are being taxed in this country, much more so than a Donald Trump re-election.
Well, Jeff, I mean, what's your outlook then for returns going into next year? Because as Townsend pointed out, after a great year this year, many are wondering, is this as good as it gets?
Yeah, I mean, if you look at election years from a historical standpoint, they actually haven't been bad years. But if you go back and say, okay, a Republican being reelected versus an incumbent Republican being reelected and an incumbent Republican losing. An incumbent Republican losing, the markets have been negative, about 6% negative, and an incumbent Republican being reelected has actually been positive for the market. So going in, I mean, looking at the election, I think it's a little uncertain to be driving where the markets might be a year out, my best guess would be for positive things going on, probably 7-8% positive return, so a little bit below average, but still very positive to be investing here in the U.S.
Okay. Well, Jeff, fortunately, you're staying with us, so we will have more time with you coming up just after this break. Thank you so much. More. Let's get back to Jeff Powell from Polaris Greystone Financial Group. Jeff, we talked a lot about looking into the crystal ball for next year, but in the here and now, what are you doing in terms of rotation, if at all? I mean, if you're looking at perhaps sectors such as tech, names that have done so well this year, are you looking to rotate and get out and go elsewhere?
We're not looking to rotate out of tech right now. I mean, tech is obviously, like you said, done very well. There may be a little bit of year-end profit-taking within that area. We took a few chips off the table about 3-4 weeks ago where we started to see a little bit of uncertainty. But looking at places like financials and healthcare as being a little bit better value in this market than other areas, like a consumer discretionary, you've got to be very, very, very specific within it. Some of the more defensive areas of the stock market are some of the most expensive, being utilities and consumer staples.
One concern with healthcare, though, I mean, in an environment in D.C. where politicians can't agree on much, they seem to agree on going tough on China and also on healthcare in terms of trying to bring drug prices down. Does that not pose substantial risks for the sector as you see it?
Yeah, you're 100% correct. It's part of what suppressed some of the value within healthcare. I think you're going to have to be very, very selective with the industry and sub-industries that you're going to participate within healthcare. That all being said, if there isn't government intervention, it's a very well valued part of the stock market. So don't be married to it. If you do start to continue to see pressure on that area, you could you could end up getting a little bit hurt. So again, something that you want to at least have your stop loss in place if you're going to participate in that area of the market.
Right. Jeff, there was a note put out by Goldman a few days earlier which talked about how, you know, it was perhaps prudent to look at the laggards on the index into 2020, because if you look at the breadth of the S&P 500, only 10 to 15% of the index is right now at record highs, pretty much mirroring the index's move as well. But do you think that there's a case for a catch-up from the laggards? And they, of course, outlined some names: Yelp, Cree, Under Armour. These are some of the names that can actually do a catch-up. Do you agree?
I think it's going to be a very name-specific area. I mean, a company like Under Armour, which we have owned, you know, obviously came under attack because of supposed accounting irregularities, things of those nature. Yes, there will be places for there to be pickup. Again, if you were to start to see a trade deal come through and see the world economy also start picking up, the laggards would do quite well. Right now, if you look at the 16,000 stocks that trade worldwide, less than 20% of those have outperformed the S&P 500. It has been very, very narrow market this year, as you've just brought up. Very large cap, growth oriented. The dividend payers, the more traditional investments, have not done nearly as well as your areas like your technology stocks this year.
And Jeff, before we let you go, I mean, we do want to bring up Paul Volcker here. We've been paying tribute to the former Fed chairman, and who very sadly did pass away. And many have talked about just what his legacy was in terms of what he did in interest rates and what a different world we lived in as well. But very sadly, he has passed after an illness at 92 years old and really just known the world over. He was a towering figure as well. I believe he was 6'7" tall and towering figure in the financial world. And Jeff, many have been commenting on not only his fight against inflation, but what he did in terms of banking regulations as well. Give us your thoughts. I mean, what a different time we live in today.
Yeah, I mean, think about when he came into office under the Carter administration. You were talking about somebody who, at one point, had the effective rates of the Fed being 22%, had the conviction to do what was best for the economy, not necessarily what was best for individual investors within it. I mean, yeah, he was definitely a trendsetter. He was, somebody that I studied in college, and to sit there and think about what he did also during the financial crisis and kind of coming out and assisting within that also with the Volcker rule is really speaks volumes of who the person was, the man was as an individual, as well as somebody who really gave most of his life for public good.
No, that indeed is the case, but I think a large part of his legacy has been the Volcker rule and the capital controls that have been imposed on the banking sector post the global financial crisis. Where do you think we are in that story, so to speak, as we pay homage to this legend who actually laid down the ground rules for keeping capital controls on banks?
Well, about a year and a half ago, they started to deregulate part of his, part of the Volcker rule with regard to smaller banks, and so, there is. I think there's a history that we have to look at and understand, and not repeat the mistakes that we've done in days past with regard to being too deregulated. Some regulation is good, and part of what he was trying to do was to place some guidelines for the banking industry to play within, so they weren't going to go back and fall into situations like we did in 2008.
Yeah, that indeed has been the big debate, really, for the banking sector, something that's plagued their profitability and their overall performance now for years. But, Jeff, thank you very much for joining us with your thoughts and your insights. We really appreciate your time this morning.